What countries are the most fiscally vulnerable? Well, it probably wouldn't surprise you to find out that Greece is high up on the list. But how do other developed economies fare and stack up against the emerging markets? Barclays Capital developed a Fiscal Vulnerability Index, crunched the numbers for 47 countries. Piero Ghezzi, head of Global Economics, Emerging Markets and Foreign Exchange Research at Barclays Capital, is in London. He is here with us this morning to tell us what they found. So, we told everyone that Greece is kind of near the bottom. Piero, tell us how other major economies stacked up. Who's on top? Who kind of comes out in the middle, and where are the biggest surprises?
Yeah, I mean, the country that comes on top among developed countries, and that's not a surprise, it's actually Germany, right? And in the bottom, not surprisingly, comes up Greece, Ireland, Portugal, Spain and Italy a little bit better. I think like the news here was that, I mean, like up to last year, most people assumed that developed markets could not default or would not have a debt dynamics problem, where it was presumed that only emerging markets would have that problem. But when we see the numbers, actually what we see is that emerging markets' fiscal situation is actually, by and large, significantly better than the fiscal situation in most advanced economies. Japan and the US actually are in a weird spot because they are in the middle in terms of fiscal dynamics, but obviously their rates are very low because they enjoy what we call this safe haven status that allows them to have much lower yields than they should otherwise.
Now, why is that? Why is it that Japan and the United States have this market respect, as it were? I've looked through your methodology, and there's something called institutional strength. Explain that to us.
Yeah, I mean, it's not only institutional strength. I think institutional strength in general is something that has traditionally, historically made developed countries more stable than developing countries rather than emerging markets. So you would expect the US, Japan, Germany, most of Europe to be politically, institutionally more stable than, let's say, Brazil, Russia, or many countries in Latin America, right? I think the main reason why Japan and the US enjoy this advantage is, based on the fact that many investors are US dollar based, and Japan has a very strong domestic bid. So everything else equal, when things go wrong, right? When there's a sell-off globally, investors go back to those safe havens, countries or those assets that they actually do well during sell-offs. But this is in a way kind of circular.
Yes. Piero, a question for you. You know, people like to trash models. They like to trash indexes. How closely do your conclusions match up against what the market says, what the credit default swap spreads show?
Pretty well, actually. We are able to capture 70% of the movements in credit default swaps. I think obviously you don't want to take literally, because we're talking about, let's say, that sometimes the markets actually have a hard time capturing these dynamics. And, as you saw in Greece, I mean, even, a year ago, Greece was trading at 80 or 100 basis points, and now trades at 1,000 basis points. So the markets sometimes are slow to capture some of the problems. So I think like the way we see our indicators is almost like an early warnings, what we call early warning indicator, right? I mean, you need to be careful, and you need to worry about those countries that actually are doing relatively poor.
Piero, great to have you this morning. Piero Ghezzi, he developed the Fiscal Vulnerability Index at Barclays Capital. He calls it an early warning indicator for sovereign debt.